Hey everybody, Tim Ulbrich here, and welcome to this week's episode of the YFP podcast, where we strive to inspire and encourage you on your path towards achieving financial freedom. Today, I'm joined by my partner, Tim Baker, and we're tackling one of the biggest debates in investing, and that's passive versus an active investing approach. What do these terms mean? Why is it such a hot topic? And most importantly, what does it mean for you as a pharmacist planning for your financial future? On today's episode, we're going to break down definitions, talk about where each strategy may fit in, discuss fees and the impact of behavior, and share more about our investment philosophy at YFP. We're also going to weave in insights from Charles Ellis's book, The Index Revolution, as well as from my previous conversation with Dr. Daniel Crosby, the author of The Behavioral Investor. Tim, why don't we start with definitions, passive versus active investing? Walk us through what those mean.
Yeah. So the way that I describe active investing is these are investors that don't believe, Tim, that the markets are efficient. So you believe that you can achieve above market returns through things like security selection. So that's like, hey, should I buy Tesla or Ford or something like that?
Mm-hmm.
You could also achieve above market returns by time in the market. So you read something in the newspaper and you're like, okay, I think I'm going to get ahead of this and buy low, and then the stock's going to take off, or a combination of both. So the hard part about this, Tim, and active is like, you got to determine when and under what conditions, not just to buy, but also to sell, right? So you might be looking at, if you're an active investor, you might be looking at valuations right now in the market and be like, man, there's a bubble here. And there's a lot of people that think that, the next bubble to burst is the AI bubble. So you're trying to find ways to get ahead of it. Now, there's really two methods to kind of analyze stocks. One's technical analysis. So this is an attempt to determine it's the demand side of the supply and demand curve type of thing. So it relies on timing. You look at charts and, visually what things look like. You study past pricing trends, sales volume, that type of thing. And you're not as concerned with things like a company's earnings or a product mix or the next, the line of products or, the company's management philosophy. So it's really about studying trends. And then the other way that active investors, review securities is fundamentals. So this is the process of determining, like, what is the fair market value of a security? So you're looking at macroeconomics, you're looking at the economic environment of the industry that they're in, stock market tendencies, interest rates, money supply, that type of thing. So it's really kind of, breaking out the books and looking at, okay, is this a healthy company or not? So that's active investing. Really hard to do, and that's something that we'll talk about. Passive is really based on the concept that markets are actually efficient in pricing securities, and the bulk of investors are unlikely to outperform the market on a consistent basis. So basically, you believe that a well-diversified portfolio with low turnover rates is going to do well over the long term. So the purest form of this, Tim, is a buy and hold strategy. So this is where you buy a security and you just hold it forever. And you don't do anything. So there's no rebalancing, there's no really anything. So as you can imagine, you could have, if you have the spectrum of passive on one end and active on the other, probably the most active strategy is like where you're day trading, right? And you're using maybe algorithms and things like that to do it at a high volume. The other end of the spectrum, the passive, is really buy and hold. So we definitely at YFP are on the passive side, but we're not just buy and hold. There are things that we're doing. Sometimes I think the misnomer with buy and hold is that you're doing nothing, and that's furthest from the truth. So really, in sum, an active investor, you're like, hey, I can outsmart the market. I can get ahead of things. The active investor is like, I'm just going to buy the market and it's going to take care of me. The market's efficient.
I'm glad you said that, passive doesn't mean you're doing nothing, right? Because I think sometimes there can be that resistance to that strategy. We're just wired, right? Human behavior is we're wired to want to take action.
Correct.
And I talked with Daniel Crosby about this. We'll come back to that here in a little bit. So I think that can be difficult, but I like to think about it more like it's actively passive, meaning there's still a lot of work that's doing in terms of, what goals are we working towards when it comes to investing and saving? What's our risk tolerance? What's our risk capacity, right? And that's dynamic. That can change over time. Goals can change over time. Portfolios evolve and change over time. Investment sectors change over time, and you start to think about things like digital assets in a portfolio. So this is not necessarily, passive, obviously, in comparison to active. Those are the two buckets we're talking about, but there still is work to be done here. But we're recognizing, and I think this is really the work that Charles Ellis talked about in the index revolution, we're recognizing that there's been a drastic shift and change in investing over the last 50 years with more data that we have based on costs and evidence and performance. And there's some level of humility in that to recognize that a more passive investing approach is the path forward. At least that's the path forward that we've taken in terms of our investment philosophy at YFP. But just speak for a moment, because I know in your conversation talking with a lot of prospective clients, there can be that desire to, hey, but I'm the exception, or I like to actively invest, or perhaps I work in a sector of the industry where I feel like I have some more insights or data that are going to allow me to beat the market. And I think it's very difficult to step back and have that posture of humility, despite what the data says, because sometimes we can misinterpret that passivity as not optimizing, if that makes sense.
Yeah. And I think, the often I say this on repeat with investing, often what we feel is we should really be doing the opposite of what we should do from an investment perspective. So like oftentimes we're like, hey, we need to do more. We need to optimize. I need to, turn over this stone. And it's often better just to not do anything at all. So, and I think if you look at, so I have conversations all the time with prospective clients, and a good chunk of them will still, come in the door and they'll say like, yeah, I'm picking stocks or whatever. And I ask the question, like, how is that going? And most of the time I get a sheepish answer of like, it's okay, or it's not going great. It kind of reminds me of like, hey, I went to Vegas or I play the roulette table. It's kind of the same thing as like,
Or it's gambling.
and it's like you get kind of the same answer. So like there could be spaces in your life where you do well, like you bought NVIDIA or Facebook at when the timing was right. But to consistently do that over the course of investing career is damn near impossible. You just can't do it. Even the professionals that are CFAs or CMAs, they can't sustain that. So these are people that dedicate their lives to, technical or fundamental analysis. And what the studies have shown is that, you could have some success, but to sustain that over long periods of time, it's random, right? And you often revert to the mean. So, and in the book that Charles Ellis, that you cited, The Index Revolution, which it's a quick and easy read, but I think it kind of, really zeroes in on kind of what we believe is like, back in the day in the 40s and 50s, like maybe you were competing against, maybe the stakes were a little bit more equal, when you're an amateur investor, but now you're essentially, your competition is PhDs with supercomputers. Like that's where you're at. So even if there are inefficiencies in the market, those get swept up very quickly and the price kind of reverts to where it needs to go. So, in an active strategy, like you're typically spending a lot of time and money to try to eke out those incremental returns over the market that just, again, are not sustainable over the long time. So often is, buy an index fund. That's kind of the staple of a passive strategy. Keep expenses low. And, it's kind of a singles and doubles approach. Don't try to take the home run because, again, a singles and doubles over long periods of time, 10, 15, 20, 30 years, you're going to get a nice return, 10%. If you adjust that down for inflation, 6, 7%. And those are very much in line with how we need to be building a consistent investment philosophy over decades.
Yeah, as I've heard you say on repeat, Tim, when we talk about this topic, that if you look at the historical rate of return of the market, and obviously historical performance isn't indicative of what will necessarily happen in the future. But if we look at the data we have, right, since the Great Depression, if you are or were invested in the markets consistently over a long period of time, the markets will take care of you. I mean, that's really what the data shows us. And again, what will happen in the future, we don't know. Every cycle is a little bit different, but while the circumstances will change in terms of what allows or causes the market's ebbs and flows, those are to be expected and they have. But we see that with time in the market, if we're in it 10, 20, 30, 40 years, the trajectory of those investments is going to be in the favor of the investor that stays disciplined over a long period of time and does so in a cost efficient manner. I think that begs the question though, if that data, if we look at what has happened historically, if we look at the results of some more of these passive funds versus the actively managed funds, and then we factor in the cost of actively managed funds, and that obviously impedes the net returns even further. Like, why does this debate continue? Like, what is the reason that we still see a large percentage of the industry that has an active investing approach?
I think it's because there's bias for action. I really think that's what it is. And I think though that the numbers are starting to shift more and more, that even managers that were used to, chase returns and active have kind of come over to the more passive side. And there probably are places in the portfolio that maybe you can squeak out, especially the things that are thinly traded or, small cap or emerging market that maybe, but it's really interesting. Like, if you look at the percent of active funds, so these are like active mutual funds that are trying to beat like the S&P or whatever their benchmark is, over a 5-year time horizon, 80 to 90% of those active funds underperform the passive funds. If you go out further, 10-year time horizon, 88 to 92% underperformed. And then when you get out to 20 years, 90 to 95% have underperformed their benchmark. So, and Morningstar does this where they look at like large cap, mid cap, small cap, and you can see that like, you might have a large cap fund, I'm looking at a chart here, a growth fund that, 40% of those funds will outpace the market. But when you outpace the market and then their passive counterpart, that's over 1 year. But if you go all the way to the other side of the chart where it's like 15-year and 20-year, only 1.1% of those funds. So it goes from 40 over a 1-year period to over a 15-year period. It's 1.1% of those. So 99% of those of the passive ones are overperforming. Now those numbers if you go to a US, if you go to not a large cap but a mid cap, over a 1-year period, 33% will outperform a passive, so lower. But then in a 15 or a 20-year, 15 it's 12.8% will outperform. 20-year actually goes up, 19.3 will outperform. So, and then small cap, it's kind of the same type of trend. So I think the reason it still exists is our bias for action, which sounds like silly. I think the math shows that less is more with regard to investing, right? And really the success of an overall financial plan is due in large part to your investment management and the overall portfolio management, but it's not to pull in the levers of like, hey, I read this in the Wall Street Journal about this biopharmaceutical stock that now I'm going to buy and think that I'm going to be able to do that. So once you buy it, then what's next? When do you sell it? Because it reaches a peak. Those are the components there. Whereas like if you just buy the market, you're good. So like, the Jack Bogle said, don't look for the needle in the haystack, just buy the haystack. That to me,
I love that quote.
That to me is a tenet of what we're trying to do. So again, it's not that we're hitting, sitting on our hands. At YFP, we follow a very consistent kind of investment strategy and process of how we evaluate our portfolios. And we do this at least twice a year where we're looking at things, we're looking at the individual positions, and we're looking at things like expense, performance, the risk and volatility related to those, to those different securities, the longevity of how long those funds have been around, the incoming yield, the purity. One of the things that we often see is that, a mid cap fund is actually like a large cap fund or a small, like there's drift there. So we want to make sure that the percentage of our portfolio that we're actually invested in is there for that purpose, right? It's not, there's not a drift, and Morningstar has these different ways to measure that. And it could be other things like who's the fund provider, what's the size of the fund, is there turnover and tax drag? So these are things that we assess in our portfolios. And there's been times where we'll say like, hey, we were in this large cap fund and now we're switching out with a different large cap fund because we like it better. We think going forward, it's going to be a better, but like, we're looking at costs, we're looking at performance, and then we're setting up rules of how we're going to rebalance. So we typically follow a drift rebalancing where it automatically rebalances the holdings in the account as it drifts away from a target weighting that's set in the performance. So, or set in the portfolio. So that is not passive, right? We're still on the passive side of the spectrum, but there's a lot that we're doing on the back end to make sure that we are as optimized within the confines of a passive strategy, right? We're not going to try to, pick the home run stock. We're going to buy the market and then basically, rebalance it over time, keep costs low and that type of thing.
And what I hear when you describe that philosophy, Tim, is that, again, actively passive, right? We're taking advantage of what the data tells us in terms of optimizing performance while keeping fees low, right? We're taking advantage of that aspect of a passive strategy, but it's very active in the sense that not actively trading, but active in terms of the process of making sure we're optimizing that portfolio and doing everything that we can, that once we have that saving strategy in place, again, we're taking advantage of the performance from a passive strategy, keeping those fees lows, but work to be done, throughout that process as well. You started to answer this, but I want to go here a little bit further because I think someone that hears this, especially I'm thinking of the DIYers out there, might hear that and be like, thank you so much, Tim, for, further validation that I can do this myself, right? If less is more in terms of, not actively trading, buying the market, we have tools out there that can readily rebalance portfolios, right? Things that in days gone by, were more difficult to do. You and I both know that there's so many other aspects to the financial plan and even so many other things to the investment side of the plan. But someone might hear this and say, oh, well, why would I ever engage with an advisor to help me in this if less is more and I have low cost tools that are already available and out there on the market? Like, what would we say to that?
Yeah. So I often say to like prospective clients that like when it comes to like our investments, like we are hardwired to get in our own way and potentially make catastrophic mistakes with regard to our portfolio. And that could be as simple as like, selling low and then buying high. And 9 times out of 10, when I say that, especially like more overconfident pharmacists that are doing this, they're like, well, that's not me. I'm like, it is you. Like if you're human. So Crosby says in his book, basically that like markets are efficient, but people are not. So our biases create cycles of boom and bust, and really are the rules that we establish in our investment philosophy, how we work with clients. We are pre-committed to a system to protect you from yourself. So one of the things that Paul Eichenberg would say back in the day is like, the reason I have a financial planner, a financial advisor, is to keep me at an arm's length for my own money. And it's almost, and a lot of this is like, stocks are the only, when the stock market goes down, it's the only time where things are on sale where we don't want to buy it. Right. And then the other side of that is like when prices are soaring, we want to shovel more money into that. And we know it's cyclical. So like,
especially in the news cycles that we're in.
Like
24/7.
Like right now, Andrew Ross Sorkin is positioned in his new book that he's releasing, and they were I think 60 Minutes interviewed him, and they're basically like, the question is, are we going to have another like market crash? And like, when's that going to be? And he's like, I can't answer when we're going to have a market crash, but we are going to have another market crash. And which has
been true forever.
Right. It's always been true. So like, it's not a question of if, it's a question of when. And again, we are wired because of how we view loss and loss aversion to do irrational things with our money. Right. So and even in this is what I do for a living. When you see like, hey, we're managing X amount of millions of dollars, and then the next day you wake up and the market's down, and we're now managing a lot less because of how cyclical the market is. Like, you feel that in your bones, right? But I think what a financial planner does is manage those behavior and say, like, hey, in these moments, we're keeping the long term in mind, right? And we want to make sure that we're following that plan, because we talked about this in the good times. And when we have some dark times, we know that it's not permanent. We know that the market typically corrects, and when it does go down over a 2, 3, maybe 4-year period. And that's typically, if you're in accumulation phase, when the market does correct, that's typically where you can make hay, because you're buying securities at a cheaper cost if you're dollar cost averaging, which then when it recovers, catapults your portfolio forward. So it's a little bit of, gymnastics, mental gymnastics to work through it. But yeah, we are wired to do things that ultimately lead to a catastrophic loss. And our job working with with clients is to mitigate that in the best way possible. Right. And often it is to hold the line and keep bad behavior in check.
It goes back to, right, letting the markets kind of do what they do, and making sure that we can get ourselves out of the way. I mean, Daniel Crosby just beautifully talks about this, in his work around the psychology of how we think about, money. The thought that was coming to mind, Tim, and obviously there's a self-serving interest here because we firmly believe in what we do and the value of the financial planning that we do with our clients. But the thought that was coming to mind is, while the evolution of the industry in terms of the accessibility of low cost, it feels like a race to zero, right? In terms of fees on products that are available to the consumer, not having to necessarily go through someone to get a product. Like, the accessibility of low cost products and the technology supporting individuals with those products, I mean, that has been a consumer win, right? But on the other side of that coin, I think if we're not careful, that can also potentially increase our risk to feel like we're overconfident in what we're able to do. It gives us, you think about your ability to buy, sell with a click or two, right? It's been easier than it's ever been to fall into some of the traps investing that have been as old as time.
Yeah.
And I think the visual that keeps coming to mind, if I'm looking at a TV screen and we're talking about asset allocation and investing and rebalancing portfolios and risk tolerance capacity, all good things, like, it's a pixel, right? It's an important part of the financial plan. It's critical, but there's so many other aspects that we need to be thinking about. And how does this piece fit into the broader puzzle and the financial puzzle? And I think that's something that I hadn't really thought about as we're planning for the episode, but it's coming up in the moment, is the accessibility of these tools, and to be able to get access to these products and trade more than ever. You pair that with access to news and information, and it feels like we're set up to really fall into some of these traps that are so common.
Yeah, it's the democratization of investing, right? So, back in the day, you would have a broker that you would call, or he or she would call you and say, like, hey, let's buy and sell these securities. And it was kind of an arm's length approach. And now you can have, your entire portfolio in the palm of your hand and, get, news on Twitter or social media or wherever, and be like, all right, click, I'm moving hundreds of thousands, millions, tens of thousands, whatever it is, a good portion of your net worth in the click of a button. And a lot of these apps it's almost like gamified. It doesn't even feel real. We talk about that with like debt and student loans. It's almost like monopoly money. But this is your livelihood, right? This is your nest egg. So, sometimes, especially with, the behavioral overlay, it's often good to have, again, a behavioral manager, an advisor that is walking you through some of these decisions, right? And, I think it's important that, again, we are wired in a way that, especially with investing and that fear of loss, to do things that are super irrational. And, it's happened this year, right? Like, when the Trump tariffs were on the table, like, so many people clients, prospects were like, hey, should we go to cash? Right? Like, and if you would have done that in the beginning of the year, that would have been a big mistake because the market, although volatile, has done well. Right. So, you know, now you're sitting on the sideline with cash and like, okay, do we buy back in? So like, it's all these decisions that you have that, again, you're spending a lot of time, energy, mental capacity, money, because often with if we haven't said this already, like an active strategy is typically more expensive with more turnover.
Yeah.
There's tax drag, potentially trading fees, that type of stuff. So, you know, it's kind of a keep it simple approach. And I think when you have more of a passive strategy, I think it eliminates a lot of the potential for bad behavior, but it doesn't eliminate it completely, Tim, because there's still people that are, out there that are like, hey, this is happening in the world. I want to take my investment ball and go home. But there's 100+ years of why you shouldn't do that, of evidence. But that doesn't matter to me in this window of time, this pixel of time. So, you know, again, I think a good financial planner is gonna keep the long term in mind, and make sure that, you know, we're holding to the plan that we've built. It's kind of the same thing. Like when you come into a windfall of money, before you do anything, you should really sit down and be like, okay, what are the rules? What are we trying to achieve? And do that, kind of establish those rules before the money comes in or before XYZ happens. Because behaviors can run awry. And again, I hear it all the time. It's like, oh, that's not me. You know, I would never do that. But yeah, even unwittingly, people are, again, wired that way.
Yeah, to put a bow bit on this behavior discussion we're having, I was thinking back to Crosby's work, The Behavioral Investor. Great book. We'll link to in the show notes. Had an opportunity to interview him way back, episode 124 of the podcast. But he talked about 3 main aspects that we need to think about from a behavior. First one, and we've talked about all 3, but first one is action bias. So, right, the tendency to want to take action to trade more. And what we see from the data is that equals worse results, just from the timing of typically when we do that. The second is overconfidence, right? So that feeling of, hey, I'm smart enough to beat the markets. I have a unique edge. I have some specific expertise, whatever it is, that often backfires. And then the third, which you just alluded to a couple moments ago, would be loss aversion, right? That fear that can lead to poor timing decisions. And I think that, again, we're wired to want to pride ourselves on intelligence, but a quote that he said during that interview that has always stayed with me is that smarts can actually be your own worst enemy. And I think this is really where having some of the humility, working with an advisor, right, having an arm's length type of approach is just so powerful when we're thinking about this over the long term. And Tim, to be fair, like as you've said, right, if people are just itching and they recognize, hey, okay, I get it, but I enjoy this. Maybe it's a hobby, you know, they like to spend time doing this, like, so be it. But right, let's kind of put a box around the percentage of the portfolio that we're taking a more active approach, correct?
Yeah, I mean, I think, you know, what I say to clients that coming on is like, hey, if you're, and I get it. I was there myself, Tim, you know, back in the day, even before I became a financial planner. It's like, okay, I'm smart. I can read and look at different things and invest. And turns out I wasn't. But like, I think if I had to, if I was talking to a client that was coming on and this was a big part of what they wanted to do, I'm like, hey, for you to work with us, you know, it has to be like 5% of your portfolio. So you can have 5%
or less,
and you can do what you want to do to kind of scratch that itch. But the lion's share of your overall nest egg and your investment portfolio should be boring. It should be a passive strategy that is managed in a way that, you know, again, is going to optimize long term, right? So you know, 95% plus of your investments should be super boring, almost like paying down debt, right? So, you know, we agree upon and set an asset allocation, which sets the percentage to stocks and bonds that we're invested in. We buy the market and we're purchasing low cost passive index funds. We're not trying to time the market. We're not trying to pick home run investments. It's the singles and doubles approach. We don't have the mentality that we must beat the market. and we don't try to make investing sexier or more interesting than it is. The sexiest that we get probably is like digital assets, that some of our clients are in. That's about it. And we're not listening to the talking heads or the news, right? Because that, again, can drive, bad behavior. But, if you want to play with 5% or less, go for it. But I think ultimately what happens is that over time, the market humbles you. You don't have a future ball, a crystal ball that you can look into the future. And then you realize that, you're either wasting your time or your money to chase returns that are not sustainable.
I have no data to support this, so I probably shouldn't even say this out loud, but I have a anecdotal feeling that there's a graph that's coming to mind where as experience and age increases, the acceptance of a more passive approach increases. And I think I'm speaking from personal experience, right? And I think, I remember back in the day when I'll never forget, it wasn't a huge investment, but I've talked about on the show before. I bought some, Circuit City stock when it was like a penny stock. And I'm like convinced Circuit City is going to come back from the dead, right? Which is like laughable. It's almost like when you talk about the Sears Kmart, days.
Yep.
But, I think that that's something I wouldn't even try to do at this point in my career, partly out of just the humility of going through that. But there's also just a function of time. And I think some lived experience. Not that I have figured it out by any means, but having 20 years of experience investing, going through some of these cycles, going through the 2008 recession, going through the 2020 pandemic dip, going through the tariffs this past spring, going through the current volatility that we have been in, and kind of seeing the results of like aware of it, but not acting on it and really seeing the value of it, right? When I was first starting in my career, like people could say that, but it's like, I haven't lived that yet. I haven't actually gone through a dip, done nothing, survived, and seen the growth that's come on the other end of it. So I don't know. I don't know if you have anything to back that up in terms of the conversations you have with prospects, but it almost feels like people that are further along, maybe
Yes.
even higher net worth,
Yes.
have some more humility in this approach.
Yeah, I think the only exception that I would say there is, if we work with clients that are a little bit further along in their career and they have like a larger position in like the stock of the company that they work for, right? So there's this bias of like, hey, I want to support my company, or I really believe in where the company is going. But like, those aren't necessarily sound principles for which to invest, right? And often the conversation is like, hey, I get it. And it's okay to have a percentage of your holdings in that security, but we don't want to be overweighted there. But I would say by and large, you are spot on accurate that like, typically the most overconfident pharmacist that I see is right out of school, and they haven't had that lived experience of like getting their rear end kicked by the market and being humbled. The 50, late 40s, 50s, 60s, they either just don't want to be bothered with it, or they just have lived, so we often, as humans, we learn through wisdom or pain, right? And a lot of this you learn in pain, like, so sometimes I talk to people that I know they actively trade, and I'm like trying to, prescribe some wisdom to them, and they're like, I'm not, they're looking right through me, like I'm not listening to me, right? And those often are not great clients for us, right? So we don't necessarily work with those type of clients. It's the ones that are like, like I've been burned, I've experienced that pain. I've maybe done something that is borderline catastrophic to my my portfolio. They're like, I'm not doing that again, right? So I think there is a spectrum, and I think it's just time and experience that you see that, and it again, it can be very humbling. Most of the people that we're working with are very, very intelligent people, but the marketplace is efficient, right? So like those things that you think give you an edge don't in fact give you an edge. And if they do, they're often illegal. You can look at like how our Congress trade, things like that. Not to be political, but like, those things are often, not above board.
Yeah. And just to build on the passively active, approach here for a moment, I want to make sure that we're not giving off the impression that this is put your head in the sand and never pay attention to what's going on, right? I mean, I think there's something to be said for that. Like you and I often talk about, even in our position, early 40s, like if there is a bubble that pops tomorrow, next week, 3 years, 5 years, right? Not a matter of if, but when. Like we have a long horizon for that portfolio to recover. But if I'm listening to this and I'm in my early 60s, late 50s, retirements within a 5-ish year window, like again, we can't just put our head in the sand and we start with one investing approach and we end with it. There's work to be done here to make sure that we're evolving our investing plan and we're factoring in risk appropriately. That if I'm 5 years out from retirement, that's very different than if I'm 25 years out from retirement, right?
Yeah. I mean, if I'm 25 years out of retirement, like I want the market to crash. Like, is that controversial? I don't know. I think most people would be like, what are you, crazy? But like, if I have 25 years left in my career, I want it to crash, because if I'm putting $20,000 into my 401k, like I want those prices on sale, right? So that $20,000, the amount of shares that I can buy in my 401k, I'm going to get, instead of buying, 100 shares, I can buy 150 shares, in whatever pay period. And then when it recovers, I feel that, those gains on the backside. So the volatility is someone in the accumulation that's their best friend. Now the problem is we don't feel that way. I always make the joke when the market goes down, whoever you are, you want to take your investment ball and go home. So it means you want to go to cash and be in that safe haven and not experience those ups and downs in the market. But that's the reality, is when the market goes down, your money goes further if you're kind of following a drip, in which many of us are in a 401k type of thing. If you're closer to that, so we kind of talk about your target retirement date sits in the center of the eye of the storm. So typically, if I'm going to retire at 65, then from 55 conservatively, or 60 more aggressively, to 70 to 75 on the other side, that eye of the storm is typically where you want to be the most conservative. Because what you're really fighting against here, we talked about this on other episodes, is sequence of return risk. So this is, I'm in the eye of the storm. So I'm going to retire at 65 and I'm currently 62, right? So I'm 3 years away and my $2 million portfolio all of a sudden drops to, 1.25 million. So now I'm like, that's a problem. And, I'm super aggressive and I have to retire at 65. I have no leeway. So now maybe that's recovered a little bit. It goes back to 1.4 million by the time I retire. But now I'm basically drawing on 1.
Down.
So I have yet to recover what I've lost. And now I'm drawing 80, 100,000 on that for the next 20, 30 years. And that's where you see the most failure of a portfolio, is when the market is depressed and we're actively drawing on it. And that's called sequence of return risk. So there's ways to basically inoculate the portfolio. So if you're in the eye of the storm, it still doesn't matter, right? And again, in most cases, the market's going to recover in 2, 3, 4, 5 years at the longest. 4 years, I would say, typically at the longest. So there's ways in which you approach those that are right on the precipice of that sequence of return risk, that, again, you're not doing anything hasty, which again, we're wired not to do, not to do those things. So, or to do those things that are necessarily, along the lines of bad behavior. So, depending on what camp you are in, again, the threat of behavior is still there. It's just a matter of like, okay, are you willing to, hold the line and adhere to your plan? Nick Murray has a quote that says, "Permanent loss in a well-diversified portfolio is always a human accomplishment of which the market itself is incapable." So basically what he's saying is, like, over the long term, the market goes up, especially in securities. We've never had a rolling 15-year period where the market's gone down. You can go look at the Great Depression, the Great Recession, even those catastrophic events nestled in a 15-year period, it still is positive. It only becomes negative is when we make it so, i.e. we go to cash and then, we freak out and are trying to figure out how to, lessen the blow.
Yeah, one of the things you have me thinking about is the shift in mindset it requires of an investor in these different phases. And again, where I think an advisor could really be helpful. So you talked about the eye of the storm, right? And the need to be conservative in the eye of the storm. If I've been for 30 plus years really dialed in on like growing my assets or investments, and now I'm going in more of like a protection mode, right? Especially if that were maybe in a season where the market goes up and you're like, oh man, I'm missing out. There could be some FOMO in there. And it's like, no, we're doing what we need to do. Right. But it's just like that transition to retirement. We've been saving for 30 years. Now we have to train ourselves to be okay spending money.
Yeah.
Like just different, mindset shifts that go well beyond the dollars, when we're talking about planning for retirement.
Well, and that's why in the Vanguard study that they did in 2000, the advisor alphas, they basically said like a good advisor is going to get you a 3% per year return that you wouldn't otherwise get, if you were doing it yourself. So basically, what they showed is that, in a hypothetical portfolio of $500,000 over 20 years, I believe it is, that $500,000 for the DIYer grows to 1.7 million. For an advisor managed portfolio, it grows to 3.4 million or 50% more. And that equates to 5% per year for a DIYer and 8% per year for an advisor managed portfolio. But so that's a 3% delta. That's the advisor's alpha. But what they determine is that half of that 3% is behavioral. That 1.5% of the work that the advisor does with a client is to prevent them from those catastrophic losses that is ingrained in our brains because of our inability to deal with loss and that type of thing. So you're right. Like whatever season of life, whether it's an accumulation, withdrawal, there's time to be conservative. But then if you're looking at the way that the markets are behaving, you're like, am I missing out on that?
Yeah.
Now, I think it's okay to do that, but something has to give. So like, what I would say to a client is like, yeah, we can continue to be aggressive. However, that retiring at 65 or whatever the age is, we got to now write that in pencil and not pen.
That's right.
Meaning like if the market does tank, maybe we're not retiring at 65, maybe we're retiring at 67. Are you okay with that? And if they're not okay with that, then we have to stick to the long-term plan of like, okay,
working part-time.
Yeah, exactly. So, and that's the rough part, is really, again, it is about having a plan, but it's more, the emphasis is on planning. So it's being able to adapt. But I also, with the investment perspective, is keeping the long-term in mind. And we do a really poor job of that as humans because emotion gets in the way and it just leads to irrational behavior.
And the last thing I want to touch on, we've talked around fees, but I want to go into that just briefly here as we wrap up. And I know we've talked on the show before about the impact of fees and the drag that they can have, right? But we're making the argument that when it comes to an active approach, high fees plus underperformance, right, versus a passive strategy makes it really tough to justify an active approach. So how much do fees matter? Why are fees a critical differentiator? I think sometimes we either might not have visibility into these fees, or we might look at some of these numbers and say, well, 0.05% versus 0.35%. Does it really matter, that much? What are your thoughts here?
Yeah, I mean, I think when you compare passive to active, passive investing gives investors the market return at a low cost, right? Active funds generally charge higher fees. So you have higher management fees, research, trading, than passive, which ultimately eats into your returns. So, and the other thing is active managers also incur higher turnover. So this is just due to more frequent trading, which then leads to more things like short-term capital gains, long-term capital gains compared to lower turnover passive funds. So, I think when I look at this, I think that two of the big things that I harp on in terms of investment philosophy is the asset allocation, and I would also put in asset location, which is kind of doesn't get the headlines that asset allocation is, which is just really the percentage of stocks and bonds. That's 91% of your long-term performance is there. But I think the other big thing is keeping expense as low as possible. So that's what I'm talking about with expense ratio. So typically, the expense ratio is what the fund takes to be able to manage the fund. So if you're doing a lot of active trading and research and analysis, it just costs more money. So I don't have the stats in front of me in terms of, but like a recent case is, to kind of give you an idea, is that I had a prospective client that, I was looking at what they were invested in, and it was a hodgepodge of both active funds and passive funds.
Yep.
And I think their all-in expense ratio was something like 50 basis points, 0.5%, just for the expense ratio. So if you have $100,000, that's $500 a year that's just into the ether, right? It's not on a statement anywhere. It's just what the fund is taken to try to, again, outpace the market. So with our funds or with our investment philosophies, we drive expense as low as we can. That same type of portfolio, our expense ratios that in the funds that we use are 0.05 or 5 basis points. So that's $50 on a $100,000 portfolio. So one of the things that I believe is like, so that's a factor of 10x, right? Between those two.
Yep.
So unless I'm getting 10 times the performance, or it's 10 times safer for the same amount of performance, why am I paying that? And often the answer is like, I don't know. I didn't even know I was paying that, because again, it's kind of lost in the fold. So to me, and I've seen these, Tim, that have been way north of 1%, 1.5%, 1.75%, which again, 1.75% on $100,000 portfolio is $1,750, right? So if you can imagine where most of our portfolios should be or should go is $1 million, $2 million, $3 million. You can see how those dollars can add up over time. So asset allocation and really expense, if we can get these right, it really, again, eliminates drag and allows your portfolio to be a rocket ship and really see the returns. And oftentimes we just don't know what we're paying or what the strategy is. I'll ask that question of like, what's your investment strategy? You're like, I don't know. But we should have one if we're managing hundreds of thousands, if not millions of dollars of assets. We should absolutely have one.
Tim, great stuff. We've covered a lot. Define passive versus active, why we feel like the passive or the actively passive approach works for most, the importance of fees, why fees matter, why behavior matters, and some of the lessons that we've learned from Charles Ellis's work in the Index Revolution, Daniel Crosby's work in the Behavioral Investor. We'll link to both of those in the show notes, along with the interview that I had with Dr. Daniel Crosby back on episode 124. And if you're listening, you're a pharmacist wondering whether your portfolio aligns with your goals, or perhaps you're questioning your current advisor's approach, we'd love to help. You can learn more at yourfinancialpharmacist.com. You can schedule a discovery call to learn more about our one-on-one, fee-only comprehensive financial planning services. And as we wrap up this week's episode of the podcast, if you like what you heard, do us a favor and leave us a rating and review on Apple Podcasts, which will help other pharmacists find the show. And finally, an important reminder that the content in this podcast is provided for informational purposes only and is not intended to provide, should not be relied on for investment or any other advice. Information in the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial product. For more information on this, you can visit yourfinancialpharmacist.com/disclaimer. Thanks so much for listening, and have a great rest of your week.